Hello and welcome to another episode of Nothing Ventured with me, Aarish Shah. Today in the studio with me I have Harry Morgan. Harry is a principal at 7% Ventures, a VC firm backing founders who aren't just building another app, but tackling genuinely hard, world-shaping problems. As a former founder turned investor, Harry leads investments into climate and deep tech startups, sectors that are long on hype, heavy on capital, and short on quick wins. Alongside this, he co-founded Social Mobility Ventures to confront the uncomfortable reality that venture capital too often amplifies privilege instead of opportunity. We're here to unpack the hard truths of investing in real-world change and challenge some of the cozy narratives of venture capital head on. In today's episode, we talk about working at the intersection of journalism, operating, and investing, why if you start at the back of the deck and the numbers are big, it's a pretty good sign, how if you consider climate a hardware problem, it's incredibly difficult to make a return, and how climate sees smaller exits over longer timeframes.
It's around 11 years versus 7 years for software in climate, and those exits are smaller as well.
Why the government needs to decide what we want to be good at as a country and where do we want to be to de-risk the science.
Governments need to really just decide what do we want to be good at as a country, where are we going to put the money academically to de-risk the science.
And how VC is an industry where you have to have bias. You just have to try and train yourself for the right kind of bias.
You have to have bias. I mean, you have to train that bias to back great founders. You just need to be making sure that you're building the right kind of bias.
How 15% of state-educated individuals receive pre-seed funding, but that jumps to 50% by the time you get to Series B.
At Series C, it's 50%.
And how some VCs are trying to fix the inherent issues in venture. They see the problem, they solve the problem. Right, let's get into it. Hey guys, whilst I've got you for a second, I just thought I'd reintroduce myself. My name's Aarish. I'm the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, we'd really appreciate it if you could like, subscribe, and rate wherever it is that you listen. And if there's anything you want to talk to me about, whether the podcast or anything else, do reach out to me on LinkedIn or Twitter. I'm always up for a bit of a natter. Right, let's get back into it. Harry, really great to have you in the studio. Thank you so much for joining me. This has been a bit of a while of negotiating diaries, I think, to get this book. But really great to have you in the studio.
Yeah, glad to finally be here. Definitely my fault. It's been delayed.
No. Well, let's talk about kind of your journey from sort of founder to investor and potentially back again. Let's see. You've been a technical founder, you've been a developer, you've been an analyst, and now you're a VC. So how does your past experience kind of shape the way you approach investing? And are there lessons from your founder days that give you an edge, or perhaps maybe even biases that you need to manage?
Yeah, I think probably consistently of what I've done over the past sort of 5-10 years it's been in tech. It's definitely been like getting to grips with complex technical concepts and then either trying to communicate those to other people, be that investors or other stakeholders or readers, in the case of my work at Rethink. But yeah, definitely with move to 7%, it's been trying to invest in those technologies and get to grips with the deepest scientific concepts we can that are at that point of commercialization. I think in terms of my learnings as a founder, I mean, the startup I founded, we barely got off the ground, to be honest, but I think there was probably more learnings in running that for 18 months than there was in sort of running the Rethink Energy arm of Rethink for 4 or 5 years. Yeah. I mean, we were doing a decentralized network for microbreweries to do D2C delivery. So during COVID, if you wanted a beer in a park, you could have a cold beer delivered to you in sort of 20-30 minutes. Not the world's biggest problem, very microcosm of COVID. But a lot of learnings there, I think, when it comes to working in consumer and in how you really have to obsess over unit economics. I think people had a lot of cash in COVID, were happy to spend £8 for a can of beer. Yeah. Not something that exists when pubs reopen. So very much decided to call it a day when that happened in COVID.
Although a pint is I don't know, is it 12 quid a pint? I don't drink.
Yeah, maybe we should have done it in London. I think London would have made more sense. Bristol at that time, pints were a little bit cheaper.
Yeah, well, and then you got the Corrie tap. So like if you got an cider, you'd probably be in a loss maker.
Yeah, exactly.
But I mean, what's really interesting, right? Because there are obviously some very obvious kind of journalism into investing stories. I think Michael Moritz, if I'm not mistaken, was a journalist before he started investing. And there are, I think, the discipline you learn from journalism is like, how do you get deep into story? How do you really understand what's happening technically. But the flip side with investing is, yes, understanding the technical stack and understanding kind of the science, especially if you're investing in deep tech and kind of frontier technology, you need to, but by its very definition, it's frontier, right? So you can understand the science to an extent, but a lot of it is going to be a bet on what that science develops into. How do you kind of reconcile the financial uncertainty? Because ultimately that's what it comes down to, right? Like, I mean, if you're going to invest, you're investing to make a return. So you could invest in really cool science, but how do you kind of think about bridging the science and the commercial aspects?
Yeah, I think it's a really good question. And it's a question that I think a lot of deep tech funds get wrong. I mean, a lot of it comes down to founder ambition, and I think that the outcome size that the founder's aiming for, and generally that's the ambition that we try and back versus any sort of immediate financial gain. I mean,
actual proper venture.
Yeah, I think so. I mean, if you start, I guess the classic thing is if you start at the back of the deck and the numbers are big, then it's a good sign, right? I think what we're seeing more and more is companies that are looking to integrate vertically and take up more of the stack, and I think that's what's getting us really excited at the moment in terms of the ability to iterate more on both the upstream and the downstream and to expand that product offering. So I think that is definitely a way of increasing that financial upside. I mean, we're in venture, right? So it's a power law game. We can be wrong a certain amount of the time, right? And it is going to be those outlier returns that define our fund. I think you can get too down in the weeds when it certainly comes to pre-seed and seed on the finances. And we definitely try not to do that. So we very heavily index on the technological step change or the step change in like a KPI for the user. And we very heavily index on the founder and their, not necessarily their track record on like the CV, but definitely their track record on execution and showing that they can deliver what they promised to deliver. Because I think that's something I think you can only really understand if you spend time with founders in the lab or even just in their offices and seeing them deliver on what they said they're going to do. Because the amount of founders we've seen and given advice to who have nodded along and then not executed in 2, 3, 4 months is insane. So that's definitely something we try and mitigate for. But at the end of the day, we try and invest as quickly and as with as much conviction as we can. So it's a case of sort of balancing those two things, which I think can sometimes be very hard.
Yeah. No, I mean, like, it's really interesting what you said about not trying to over-index on the financials, because like a lot of conversation I have with especially very early stage founders is like, don't hire us to build out your financial model. It's like a complete waste of your time, but more specifically your money, right? Like at this stage, you should be just trying to figure out how to get to product market fit, whatever that looks like. And that could be different for different types of businesses, right? Product market fit for a deep tech business is probably going to be further out. Like it is the wrong metric to be following, but what you are trying to do is prove out the science or prove out, some sort of demand or nascent demand for what it is that you're doing. And it's one of the difficulties that I face. And I've said this on the podcast many, many times, coming from a finance background and from a kind of more traditional business background originally. Like when I'm looking at a business, I default to looking at the numbers. And obviously at very early stage or pre-seed seed, certainly the numbers are, I'm like when we build we know that the numbers are made up, right? Like, I mean, not made up in terms of just plucked out of thin air, but ultimately there is relatively little data to back up the numbers. It is only once you get into post-product market fit where you are, you're starting to see real delivery on the commercials that you're able to then say, okay, fine, well now I can build a model that makes sense. But I think to your point, like it's so much of it is hyper dependent on the founder. Yes, their ambition, yes, their ability to execute, but also their ability to bring a team around them. I think like that's the other often kind of maybe I wouldn't say it's sort of undervalued, but I think some people often miss, because from my perspective, founders can be absolutely phenomenally great, right? And often are absolutely phenomenally great, but typically in one kind of very narrow sphere. So they're either technically incredibly, knowledgeable, or they maybe have great commercial sense or whatever it is. But running a business, there's like 30 other kind of things that you need to think about. And like, if you don't build that team around you, that can be really hard. So how do you think about that, especially with the kind of stages you're working with?
Yeah, I mean, when it comes to founders, I think there's kind of approaches you can take. You can either really specialize vertically, and there's definitely value in that. I think when it comes to knowledge intensive domains, so quantum, life sciences, there's a lot of value in a co-founder in having that depth in that vertical. The other option is obviously that as a co-founder, you go horizontal, you go general, and you understand what makes an exceptional legal decision, what makes an exceptional commercial hire. And I think increasingly, those are the founders that I'm really excited to back. I think you can
buy in the expertise, right?
Yeah, and I think it's almost your ability to sell the vision, not only to investors, but also to those early hires that are so crucial to building that business. And if you can convince someone who's been heavily embedded in an industry that your vision for how that industry is going to transform is the correct vision, then that's a really good sign as a founder. And I think, especially when it comes to a lot of the hardware deep tech that we do, the fundraising journey is so long, and your role as a CEO has to change so many times from pre-seed, seed, Series A, Series B, that you need that adaptability and that ability to generalize more often than you need that sort of PhD level insight on a sensor stack. I'm not saying that makes a bad founder, but I think definitely when we look at founding teams, we look at their ability to generalize.
Yeah, I mean, as a generalist, I couldn't agree with you more, but that's kind of that's maybe my biases coming through. But what I would always say is, like, to your point, building a business is an exercise in generalism, right? Like, you have to be across HR, you have to be across ops, you have to be across finance, you have to be across commercial, etc., etc. And you can have the most phenomenally, experienced individual in their domain, but that, and they could build an incredibly valuable product in and of itself. But if they can't build a business, I remember one VC telling me, this founder is great at building revenue, but they're no good at building a business. And that really stuck with me because, one would say, well, okay, revenue is a good thing. It's like kind of a core necessity within a business. But what he was essentially saying was like, yeah, he can go out and sell, but he can't build a business to scale around or to scale in the future around the commercial kind of contracts that he's bringing in. And I think also in a world where obviously the proliferation of AI, the ability to build out tools in a way that you couldn't in the past, obviously in the domains that you're investing in at 7%, that's a bit harder because it's typically hardware and hard tech, let's put it that way, right? But, with the more kind of, let's call them traditional SaaS software type businesses, where you need less sector knowledge to actually build, that obviously means but you need to have an edge elsewhere, and that edge, I think, to your point, is around that kind of commercial business knowledge. And it's something like Entrepreneurs First, I think, realized a few years into their journey, right? Like, they were putting technical founders together, but actually they realized that the balance was a technical plus a commercial or kind of generalist. I want to kind of pivot. We've talked about this a little bit already, right? But 7% invest in genuinely hard problems, right? And we've had the partners on on the podcast in the past as well. But honestly, is venture patient enough or even built to solve kind of multi-decade challenges like climate, right? Because I often wonder whether venture starts becoming part of the problem rather than the solution, because you back a founder, but you need your exit within 7-10 years, right? For it to make sense from a fund performance perspective, especially in a world where DPI has been shrinking, et cetera, et cetera. So how do you get over that? And then, given that so many climate tech investments depend on subsidies or policy shifts, and we've seen that happening in the UK recently, hydrogen, carbon capture, is an element of this kind of with VC, and obviously with 7%, you've kind of stuck to your lane very, very specifically. But others who've kind of dipped in and dipped out again, are they maybe taking a bet on some of the macro situations, or is there kind of something deeper? And I guess, given the sort of hype cycles we're seeing with AI and climate tech and of late, like, how much of the portfolio today might seem either misguided 10 years from now or potentially misguided when first invested? And like, what are you hedging it? I know that's a very broad, big question, but I guess the point is, like, how do you solve for the fact that these are multi-decade long-term challenges in a world where venture chases relatively fast returns, right? Like you want to see max 15 years, 13 years in a company.
Yeah, it's an interesting question. And I think there's a lot to unpack there. So when it comes to things like climate hardware, so I think it's making the broad assumption that a lot of the climate problems with software have already been solved.
Yeah.
If you consider climate to be a hardware problem, there's definitely structural things there that, as you said, with the timeline you're expected to return a fund in, that make it very hard to back climate hardware. And I think that's why in Climate Tech 1.0, around half of the money was lost that investors put in at the start. I mean, if you look at, I think, hardware exits, I think it's around 11 years versus 7 years for software in climate.
Yeah.
And those exits are smaller as well, right? So why take the risk as a fund to invest in climate hardware versus software? I mean, a lot of that, I think, comes down to market timing. And I think that's something that is quite hard to look back on and learn from mistakes about what is right and what is wrong. I mean, I think we've learned the hard way with things like AR and VR on betting too early on a market that might not materialize or materialize in the way that we thought it would. And I think that's one of the benefits of not being a heavily verticalized fund, right? I think is that you can make those market timing risks, and that to one of your points is what you are hedging against. I think if we're doing things in space tech where there's a huge amount of stacked market timing risk in terms of like cost of launch and cost of return, that is something that we are making, that a lot of our companies are making existential risk on, right? In a 5 to 10 year horizon. The same with things like nuclear fusion, for example, which we've recently made some investments in. So there's definitely a lot of hedging that we do in different sectors of deep tech, but we can afford to be wrong probably 80% of the time, right? I mean, if we do a nuclear fusion company at pre-seed and it succeeds and becomes a commercial nuclear fusion company, that's a generation defining company. And will do more than return the fund. So in terms of the percentage of companies that might seem misguided in 10 years time, it probably will be. It'll be over half. Not all of that will be because of like hype cycles like AI and climate. I think a lot more of that will be down to execution found. I mean, the interesting thing, I think, if you look at our portfolio and our failures, I mean, we've been around for 10 years and we've probably got about 10, 20 companies now that have wound down. I can only think of one that has failed because the technology hasn't worked. Right. Which, as a deep tech fund, I think is something that people over-index on when they're assessing us.
So okay, just dig into that for a second. So the ones where the technology worked but the company still wound down, what happened?
I mean, numerous factors, right? Some of it is market timing risk, and some, going back to your point on government regulation, have been overly dependent on things like green premiums, things like one of our companies has failed because making tax digital as a policy was pushed back, which I think is. I mean, you have to make existential risks with conviction when you're founding a company. I think you learn that the hard way, and I think when we're looking at sort of the next iteration of climate companies, for example, we definitely consider them very differently. We look for a different edge other than just their climate impact. So if you look at like Tesla from like Climate Tech 1.0, it succeeded because it was a better car company. Yeah,
not because it was a energy efficient vehicle.
Exactly. And I mean, there's companies in our portfolio. I mean, Green Jets is a great example. So they want to become the next Rolls-Royce, basically. And they've got these fantastic electric propulsion systems, and they're real system integrators in terms of how their business model works. They're integrating it into commercial drones. They'll look at implementing them into like aviation systems of the future. There's loads of defense applications there as well. And their differentiation hasn't come from the fact that they're electric and zero carbon, but it's come from the fact that these engines are 10 times quieter to the ear. So that obviously opens up a whole new bunch of applications, gets around a whole bunch of regulatory hurdles that existed previously, but they're not dependent on green premiums. They're not dependent on someone buying it because it's
cool,
because it's green,
it's the mode, or whatever, or it's the fashion or whatever of today. I mean, that's super. Yeah. So I mean, I think it's I think you're right. It's what does a business have to offer that goes beyond the kind of headline, as it were, right? Like there has to be something fundamentally. It's the whole build a better mousetrap, right? Like, I mean, at the end of the day, well, or don't build a better mousetrap is typically the wisdom, right? But if you are tackling a market that is large enough and already has some demand, and it just so happens that you have this secondary sort of benefit, right? Then as long as you solve the first, the first question, which is there demand for this product in and of itself, irrespective of the climate benefit, then you're essentially by stealth hacking the climate benefit into the product anyway.
100%. I mean, climate has to be viewed as a horizontal rather than a vertical, right? And I think that is something we try and apply across our investing thesis. I think we never invest in something that will make the world worse. And I think, we wouldn't invest in a company where their primary beachhead market was an oil and gas companies, right? Because I think that isn't a directionally correct bet to be making. But I think if you're looking at a lot of the trends we're seeing in industry when it comes to decentralization, when it comes to robotics, when it comes to electrification, all of those have climate impacts, but their benefits are primarily economic, right?
Yeah.
I mean, if you're shortening the supply chain and reducing logistics costs, if you're onshoring manufacturing and that is resilience to your government as your first customer, then that is a fantastic differentiation point.
And reducing consumption and fuel consumption, etc., because you no longer have large logistics cycles and shipping and so on.
Yeah, 100%. And I think that's really how we try and look at climate. We try and look at companies that are making the planet smarter rather than making it greener or depending on subsidies from governments. I do think government has a role to play in a lot of it, especially as a first customer. And I think that's what we've seen work really well in defense. I mean, if you look at lithium-ion batteries, for example, the real cost curve on that was from governments buying drones. So I think if we can have government coming in with contracts rather than grants a lot of the time, I think that can be a real catalyst for boosting sovereign capabilities in areas that we have excellence in. I mean, in the UK, we have some areas that we are academically the best in the world at. So,
or at least historically have been.
Yeah, at least historically. I mean, it's a moving target a lot of the time.
Yeah, I mean, there's a lot of changes happening. I mean, I remember like both of us went to Bristol, I think, and I think I had a few friends that were kind of doing aerospace, engineering, and it was just incredible, like kind of things that they were doing and the sort of the projects that they were working on and some of the projects that were coming out. I mean, the reality is that. I think I would agree with you. I mean, I think the problem is that most people think about government in terms of, okay, how can they subsidize? How can they, how do I get an Innovate UK grant? But actually, what's way more valuable than that is how can I get a contract from a large defense procurement agency or the NHS or whatever it is, right? But then the problem is government is so bloody fragmented, and it's often so difficult to find your pathway into that procurement process. In fact, a lot of the VCs that I've spoken to in the defense sector, their edge as venture investors is they have direct contacts into those buyers, right? So they can get the technology into the hands of actual users and then the actual buyers, which shortcuts a lot of the pain that obviously these companies would have to go through if they were just trying to do it themselves. Which, frankly, if I think about venture, what do you want from a VC investor? You want capital, but you also want introductions, and those introductions could be to a whole variety of things. But obviously, introductions to customers or potential customers is a large one. Then I think that that absolutely that works better than just we'll give you a grant, because the grant is finite.
Yeah.
And it isn't informative, right, to the company itself, right? Yes, you pass, I don't know what the panels are like now, but I think there's 5 or 6, on each panel or whatever. I think that may be even expanded. And yes, they may have some sector expertise, but they review, they say, okay, is this sound technologically sound enough that we should put a grant in to see where they go? Great, tick, move on, right? Like, that's it.
Yeah, I mean, if I had the time, I'd definitely do a request for information into who the Innovate UK assessors are and how they choose those assessors. I think there's some like terrible mechanisms at work there, and I think that there definitely there's signals that it's going to shift in the right direction. But the worst thing I think I see, and actually a lot within deep tech as well, is companies that end up on that grant flywheel. Right, it's a bit of a drug for startups in terms of your ability to go from grant to grant to grant. Getting stuck in these endless reporting requirements, getting stuck following sort of blurry objectives to increase headcount versus actually moving towards your KPI and your vision. I think that that's a real, like, it kills a lot of businesses, right?
Yeah.
And
or invest in this region, build out an offer. Yeah, okay, great. So I've just won a $500,000 grant. I've got to spend 150K of it, like setting up an office in wherever, the Midlands or Scotland or whatever.
Yeah.
Which may actually be antithetical to delivering value on the grant. Like, I understand why these grant providers do that, right? It is to obviously boost the local economy. But actually, the way I think about it is, if you build a substantial business, that trickle down into the economy in whatever way is going to happen, right?
Yeah, I mean, they're also coming in at like a really weird stage. There's a lot of like Series A, Series B companies that are getting grant funding for like small parts of their businesses that should be being funded by customers. I mean, realistically, grants need to be, firstly, like, governments need to really just decide what do we want to be good at as a country.
Yeah.
And like where are we going to put the money academically to de-risk the science? Because realistically, like, VC can take it from there, or customers can take it from there. And I think that's really what the grant ecosystem needs to adapt for. And the grant ecosystem in the UK came in at a point where there wasn't that much venture capital in Europe and in the UK. So it was a necessary thing to do, and it was necessary to spread it very broadly, very thinly. But I think we're now at a case where, if there are those signals that this company is going to commercialize, customers will pick up that company, venture capitalists will pick up that company. And I think that is a much more Darwinian way of the right companies evolving and letting companies actually fail faster, because that's something we're still terrible at doing in the UK, is letting companies fail fast.
Oh, we're awful. I mean, like, it's one of my biggest bugbears, right? Like, it's in the US, there is a much healthier attitude to failure, to company failure, than there is here. Like, I know lots of founders that really struggled with, coming out and saying, this business, like, I've done it myself, right? Like, one of the business that I try to build in the kind of finance space just wasn't a goer. I was really fortunate to have angel investors who were really supportive and were, like, this is good. I know you didn't spaff the money up the wall. Like, I'm okay with this, and we took the risk. That's what it is. But I think so many founders just have this really existential dread that if they let their business fail, then somehow or the other, they're going to be marginalized or ostracized from the startup community. Whereas actually, I think, and we see it so much with kind of so-called zombie businesses, right? Those businesses, if they just shut down, right? The founders would be happier. The investors would probably be happier because, okay, they'll either get their tax benefit back or they can write it off and it's just finished and it's done. But, who's it serving to keep these businesses going? And actually, that founder, having learned a ton of stuff in that journey to failure, may well then say in a couple of years' time, say, I'm going to pick it up again and see what I can do through the lessons I've learned through the failure and do it differently. And maybe that time it's a success. And I think, to your point, the other problem with the grants is that they are often so small as to be meaningless, right? Like, 100K grant, it's fine, but that pays for like one person, realistic, two if you're lucky, kind of thing, right? So I think, and the amount of time that you have to expend, exactly as you said, both to apply for and then to report back on the grant. Yeah, it's a lot for probably less value than I think founders get out of it. But this conversation is really interesting because my next question was going to be around social mobility, which is the other massive blocker, certainly in the UK. And I have many thoughts about the problems with social mobility in the UK, and I know you do, right? Like, my biggest issue is, I feel like as a country, we really penalize self-made wealth, and we kind of venerate inherited wealth. So, landed gentry, et cetera. I mean, this is why all of our politicians have come from those sort of circles, right? But social mobility in venture sounds great on paper, and I think it is. But is it realistic, right? Given that most LPs and GPs are still often drawn for the same privilege, like it's a closed network, right? Like it's very rarely a self-made, millionaire, billionaire, whatever the number is, who came from a council estate, who had an underprivileged background, you know, who didn't go to the right school, didn't have the right family background, etc., etc. So, like, to an extent, isn't diversity in venture a little bit performative? And I've had this conversation again with many, many people. It feels like a bit of a box tick exercise. Whereas what we should be focused on is potentially fundamentally changing who holds the power and the capital. And like one of the things I think about a lot is, you know, GP commits within a venture fund, right? If you want to be a GP, you need to stump up whatever it is, 1-2% of the fund, or it's, you know, a bit less than that. But you know, if you need 150k as a GP commit, and you're coming from a background where you haven't earned that wealth, but you are an incredible investor, like that's a massive blocker, right? So anyway, but you know, a lot of founders from less privileged backgrounds often also face very subtle but incredibly real biases from investors. So how do you personally check your own biases? When have you got it wrong, and what are you trying to do to kind of change that?
Yeah, I mean, I guess I'll starting with the thing on bias. I mean, VC is an industry where you have to have bias. Mm-hmm. I mean, you have to train that bias to back great founders. You just need to be making sure that you're building the right kind of bias. Mm-hmm. And I think institutionally, we're getting it a little bit wrong at the moment. And I think it's probably off the back of the bubble in 2021, where funds, there's a lot of capital around. So firms, as firms were building, they optimized for the wrong thing. I think a lot of the people who came into the industry at that point were those that optimized for network, they optimized for winning deals rather than for picking great companies, actually thinking from first principles, auditing their thinking and making contrarian bets. So you've got a lot of, I guess, associates that are bringing founders that are ex-Google or that have already raised a pretty substantial friends and family round to the IC because they're not going to get shot down by a partner. Yeah. I mean, we've got a lot of mechanisms internally at 7% that I guess help mitigate that. I mean, there's no veto in our IC, which I think is great in terms of letting people make contrarian bets and really having conviction behind companies and not being ashamed to bring those companies to IC as well. I think the going back to the point on social mobility, I think you hit the nail on the head. You've really got to assess that flywheel. So at the moment, it kind of goes elite education, high-paying career, maybe some angel investing. You make some money off the back of that. You can afford to start your own fund. You've got a track record from angel investing. You make some exits. That money goes to LPs. LPs send their children to private school. That's the current flywheel. That's the current flywheel we're facing. Yeah. What we're trying to build, and a project I'm working on at the moment called Social Mobility Ventures, is we're trying to create that alternative flywheel where we pull together people who are in tech from a state-educated or a working-class background to pull together and have more community in terms of both the capital and the community and the resources available to founders to start their own companies, take the risk, even if that is just moving into tech. Because if you look at the stats, it's 94% of the UK population is state-educated. It's 9% of the tech workforce are defined as working class, and I think it's around half the population have sort of fall under that bucket. So, and that is endemic throughout the ecosystem. I mean, 12% of VCs are from non-selective state schools.
So let's dig into this a bit further, right? Because I'm always fascinated by it. Like I come from private school. I come from privilege for sure, right? Like my family gave me all the tools that I needed. I wouldn't consider myself wealthy, don't get me wrong. Definitely could not afford that GP commit. But firstly, and especially under the current government, this whole concept of working people, working class people, like I think it actually does us a massive disservice, because all people, well, theoretically all people work, right? Like in the sense that, you know, whether you're from privilege or not, most people will go find a job, etc. It's only the ultra wealthy that, you know, trust fund kids that potentially don't do that. But I think there needs to be a way that we can redefine some of this terminology, right? Because
100%.
I don't think it is about working class versus non-working class. I don't think it's about, you know, to me, it's about leveling that privilege. So making sure that everyone has the access to the opportunities from the start, regardless of the background, right? Like, so, you know, obviously, and, you know, I'm not belittling or kind of trying to downplay, obviously, the systemic and often institutional biases that a lot of people will face, and they will face it because of their accent, because of where they grew up, because of the school they went to, because of the family they came from, because of the religion that they practice, or whatever, right? Like there are so many biases that are out there, the color of their skin obviously being very frankly one of them, as well as their gender. I would love if we could strip away the definitely if you're working class, it's this, if you're this, it's that. It's more a case of how do you just open up the door so that everyone has their access? And one of the things that I think again about quite a lot, and you may know Alex McDonald. He's been on the podcast, but he was one of the founders of Velocity Black. He and I at one point were thinking about setting up a charity, or it wasn't even a charity, it was more like a foundation, where we were thinking, okay, we would like to essentially donate, but it's not even, it's grant, sort of 10, 20, whatever the number is, £1,000 to people from those underprivileged backgrounds who wanted to go launch a business. It didn't have to be a tech business, it could be any business, whatever. Because I think one of the reasons that more people from those backgrounds don't launch a business, is around that fear of failure that you and I just talked about, and that, having that kind of ostracization, but it is because they don't have a parent's couch that they can go and live on. Like if things go to pot, right? They still have to put food on the table. They can't take the risk, right? So to me, it's about how do we get people to be less risk averse, but also have that ability to take risk. And obviously that doesn't mean underwriting all the risk, but it does mean giving them the opportunity to take that journey. So that was a bit rambly, but
yeah, no, I mean the objective obviously isn't. You never want to put anyone off from starting a startup. I think you're right. It's about leveling the playing field in terms of access to resources and capital, and just the ability of people to take that risk, right, and actually go and take an ambitious bet on making the world how they want to see it. I think there are systemic problems there, as you said, around social mobility, about race, around gender, and I think those things can often be solved in the same way in terms of just opening up those resources, right? I mean, from the and there's a benefit to that, right? I mean, I think if I just go back to the social mobility stuff for a moment, it's a pre-seed, it's 15% of founders come from state educated background.
Which is nothing, yeah.
At Series C, it's 50%. So there's a clear arbitrage in the resilience of those founders to get there. And I think that's probably a function of their willingness to take risk regardless of their circumstances and their conviction that they have to start that business in the first place. So there's clear benefit in being able to level the playing field and allow more people to take that risk, because it will increase chances of success. And yeah, it is a case of making more capital available for people who wouldn't have a friends and family round in their own network. And I mean, I wouldn't define myself as working class. I went to a state school in Wiltshire, and I knew nothing about tech. I knew nothing about venture. I knew nothing about how to scale a business until I tried to do it myself. And learned a lot through doing that, but there was no one in my network who could help me how to avoid the really easy problems that I face. Yeah. So I think a lot of it is around inserting those conversations into the education system and having that. And I think that's done really well in some countries. It's done really well in the US. I think it's being done increasingly well in places like France. I think the education system is really fostering a level of entrepreneurship there. Innovation. And I think allowing young people to have the ambition to start their own companies rather than go into other careers, I think is something that we need to focus on.
But that's symptomatic of our entire education system,
100%.
Again, which is 150 years old, completely based on the kind of manufacturing output-driven type of industrial narrative that we had here in the UK. And even for me, right? Like, so at my school, one of the best schools in the country, arguably, we had no course on innovation. I remember when I did IT at GCSE, like it wasn't coding. In fact, I don't believe they even currently have a computer science course at GCSE or A level at the school. But my IT course, how to use PowerPoint, how to use Excel, how to use Word, right? Like, I mean, that was it. And we were being trained to be managers, rather than innovators and entrepreneurs, which, with hindsight, despite however much I enjoyed my education and got a huge amount out of being at that school, I think it was such a wasted opportunity.
Yeah, I think if I think back to the points in my education where enterprise or entrepreneurship was mentioned, it was always around the stuff to do with tax returns or the idea of you running a small bakery or something like that. And absolutely fine.
We are a nation of shopkeepers kind of thing.
But we're not celebrating the big successes. I mean, partly that's because we don't have that many, or really celebrating the failures that people have made along the way and who have really tried to change the course of history. So I think that's something we need to do. I mean, Rutger Bregman's written a book recently called Moral Ambition. I think that's a really interesting take on
moral ambition.
Moral ambition, yeah.
Okay.
I think it's a really interesting take on people's ability to take risks and people's ability to really go with conviction behind how they want to see the world in 20, 30 years' time.
So what is the change that what change you hope to make, and over what sort of timescale?
With social mobility ventures?
Yeah.
What we're trying to do at the moment is we're trying to pull together exited founders who are state educated, put together a pot of capital to be as an angel syndicate and to back founders who are either state educated or from first generation immigrant backgrounds.
So inherently, this is where I would disagree with you. Not disagree with you. I was like, open it up to why should they only be state educated? Like privately educated, in like myself, right, would absolutely want to see more of this sort of thing happening. And maybe that's me, but I would expect. I mean, like if you think about investing, and certainly investing in tech and startups as a game of contrarian bets, to your point, if only 15% of state educated individuals receive pre-seed funding, but 50%, that jumps to 50% at Series B, you'd kind of want to play those numbers.
100%, and we're definitely not close off LP or angel money from people who aren't in that bucket of people.
Yeah.
I just think the message resonates better with people who have been through that. And you have to pick your first customer, right?
Yeah.
And that's what we've got to do.
But again, to your point, like how many I would really be interested. Like, so I'll give you a great example. I had Roger Wade on, who founded multiple businesses, but the most famous one being Box Park, right, in Wembley and Shoreditch and so on. Actually came from privilege and then didn't, if I can put it that way. When he came back to the UK, he grew up on a council estate, etc. Like he's a real self-made wheeler, like a lovely guy, right? Like he's exactly the sort of person.
The stories we need to celebrate.
That absolutely, the story that we should celebrate, but also the kind of person that wants to do more of this sort of thing, right? Like inherently believes that there is unlocked potential in the UK, that is hampered and dampened because we have a city of London where the finance sector is so powerful, and attracts all of the talent, sucks it out of the private schools, sucks it out of the universities, but actually, we could be doing so much more. And like, again, we've had guests on the podcast where, Manish Karani, he's building a business called Eureta, which has codified some of the traits that they found make great entrepreneurs. And it's about what they call HAIL, right? So hardship, something, illness, and loss. I always forget the A, but anyway, it's all about that kind of grit and resilience, right? Adversity, that's it. Hardship, adversity, illness, and loss. And actually, if you think about a lot of people that come from socioeconomic backgrounds where they haven't had money, where mum and dad may have been struggling to put food on the table, or where the school was suboptimal, they've got 40 kids in the class, whatever, right? They'll already have been through some of that hardship, some of that adversity, and so on. So it seems like an obvious place to start, because the traits that you're looking for as a venture investor, certainly, you will already find some of those in people that come from those backgrounds. Because if you come from a cushy background, let's face it, you're less likely to have experienced directly some of those, although you may have experienced some of them.
Yeah, I think you're right. I think it changes the problems that entrepreneurs are solving as well. Because I think a lot of the people who have gone through those things, I think, have experienced problems that maybe people from positions of privilege haven't. So I think we see a real shift. I mean, in the UK, I would contend that that's why we have so many fintech startups. It's why we have so many startups for startups. Is because is because that's how the system's worked for 20, 30 years.
Yeah.
Whereas I think if we look at the deal flow we see at social mobility ventures, a lot of it's focused on how do we solve hunger, how do we solve climate, how do we solve a lot of things to do with social inclusion. And those are the companies that we want to see shape the next 20, 30 years.
Yeah. I like, interestingly, when I was dabbling in angel investing, I don't have the capital at the moment, sadly, to be able to do much more. But, one of my pillars was inclusion. And inclusion could have been anything. It could have been education, could have been financial, could have been societal, whatever, right? Because I truly believe, like, so I my family comes from Africa. I was born in Africa. If you look at the tech that's been built in Africa, to your point, it's solving those ground level problems,
100%.
right? Like, so they're not trying to solve for climate, but they are actually to some extent, but they're trying to solve for how do I get the street vendor to have cash in their pockets, or not even cash in their pockets, but to be able to transact, right? And that's how M-Pesa came about. Meanwhile, we're sitting here going, what's a good looking website for HSBC or First Direct or whoever, right? Whereas they're building mobile payments before we even thought about it, right? So, you would exactly say, you would hope to see founders coming from these sort of backgrounds actually building those fundamental tools that service the majority of the population. It's not for the top 1%. It's actually for the, to your point, the 94% or however you want to skin it. I think in the UK we have lots of structural issues that make it challenging, but yeah, I mean, we absolutely need to see, more of that. Changing tack for a second, and maybe this comes out of, what you're doing at Social Mobility Ventures and equally what you're doing at 7% for that matter, right? But have you ever deeply questioned whether the VC model itself is flawed, right? And what kind of keeps you in it despite these doubts, especially at the moment? It feels like we're going through a very fundamental shift in venture. Like, there are, fewer funds returning capital to their LPs. The numbers that Carter showed a month or two ago were fairly depressing.
Yeah.
There are certainly, 2015 vintage type funds which, have not returned $1 of DPI. So there are problems, and obviously it's easy to say private longer. We all know this. The IPO windows have shifted in Europe. It's harder to exit. There aren't the acquirers. We don't have, companies with the balance sheets, etc. But if you were to fast forward sort of 20 years, what are the uncomfortable truths that you think we'll be facing about venture capital's role in shaping the next 20 years in the future?
I think on the first point, in terms of views on the VC industry, if I look at any of my role models within venture, most of them hate working in venture. I think they all have a gripe with how the industry is operated and are there to solve that problem. I mean, often these people are ex-founders, so they have that nature of see problem, solve problem. I think that's kind of it's definitely how I view trying to build social mobility ventures. It's definitely how I view our approach to investing at 7%. I think we try and invest with much more conviction, try to move a lot more quickly, try and put less barriers in the way of founders after we've invested than is broadly done in Europe. And I think we very much try and optimize for the upside, the few companies in the portfolio that are going to return the fund, versus trying to keep alive the remaining 50, 60, 70, 80%.
Yeah. And we're seeing a lot of that. Like, we've had a couple of guests recently, who have been adamant that, to an extent, venture needs to stop hiding behind power law, right? Like, you need to, yes, of course, that is how venture works. You're going to have those outside returns, but there is a core 30% of your portfolio that aren't going to have the power law returns, but you need to be actively figuring out how to find a safe and valuable exit for them, as much as, you don't want them just sort of dragging along either as zombies or ultimately winding up, right?
Yeah, and I think part of that is embracing failure and getting companies to realize that they're not on that venture path early, get through to an exit early, because that's something that, as we touched on earlier, I think companies stay in that zombie mode for too long, grant to grant. I think they don't die quick enough. And I think trying to find those outcomes, trying to get outcomes from that is valuable. I mean, I think it's arguably more valuable just for the VC ecosystem in general than it is at a fund level. I think a lot of funds are focusing on this now because, as you've said, they've not got DPI. They need to demonstrate DPI from fund one to get to raise for fund
self-serving,
two.
Yeah.
So it's a little bit self-serving, and I think that in itself is a little bit of a backwards. I think that's part of the problem in venture. I think going back to your point on optimism, I think my broad approach and my broad thoughts on this are that I think that tech is the solution to most of the problems that we face. I think in climate, in defense, in space, I think there's a lot of things that can be solved with tech. I think we're at a really exciting time now with, I guess, this sovereign approach to supply chains. It's almost like another Cold War. And I think if we look at the Cold War, that's what birthed the internet, it's what birthed GPS, yep. It's what birthed modern computing.
Yep.
And this new race for sovereign capability, I think, could be what catalyzes the next generation of fusion, quantum.
I've talked about it so much on this podcast, like, because we went through this period of peace, we actually slowed down technical development. And I think given the era we're in today, that's going to fast track it again.
100%. And I think the race, one of the things I often talk about is the race for data center capacity is a huge benefit to any sort of technology that benefits from deployability. And often that is solar, it is small hydro, because these technologies can be deployed a lot more quickly than a gas plant or a nuclear plant, right? So if those things are deployed at the scale that a lot of these hyperscalers are talking about, then we are going to see a huge cost curve in that continues in solar, right? And that could be the key to unlocking energy that's too cheap to meter. It could be the thing that unlocks commercial fusion. Yep. I think those are things that I'm really excited about in terms of where we are at the moment and what's going to happen over the next 10, 20 years. I think the less comfortable stuff to think about is the role that venture has to play in all of that. And I mean, will AI be better at building companies in 10, 20 years than humans are? I don't know. Like, I think there's still a lot of fundamentally very hard problems.
My guess from yesterday would say no.
Yeah, I mean, I agree. I think there are problems with venture, right? And I actually think that the way venture is set up means that we actually create problems as we solve them. So a lot of the problems that we've created from like Industry 2.0, Industry 3.0 are now massive climate problems that we have to solve.
Got it.
A lot of the solutions that we're solving with generative AI are creating a huge amount of problems when it comes to online safety.
Yep.
And I think it will be startups that solve those problems as they emerge, rather than those.
But they'll create other problems that will create other problems.
Exactly, and it is a loop, and hopefully those problems become smaller and less impactful over time, and hopefully they become more inclusive of more and more people in terms of the problems that they are solving.
Yeah, the way my guest yesterday described it is AI gets all the hype, cyber gets all the money.
Yeah,
like that's essentially since AI started kind of booming, cybersecurity is like ramped up massively, and yeah, I mean that recursive problem is like you're solving problems that are caused by the previous iterations that you've gone through. I think is but the techno optimist would argue that's fine. That's just another problem to solve, and we'll solve that problem. We'll move forward, and we'll move, because it still takes us incrementally towards this abundant future, right?
Yeah.
Theoretically, but if the goal of venture is to ultimately solve all of the world, and okay, that's not the goal. The venture fuels the ambition of founders that want to ultimately solve all the problems of the world. When there are no problems left, what do you do? Like, where does venture go? I guess. Right?
Yeah, exactly. But I don't
think we're going to run out of problems.
That's the
utopia
soon. I'm not sure we're going to reach. So
yeah, I mean, look, the thing that equally strikes me is, currently in the UK we have a ton of like emerging managers, very relatively small funds. We're very good at pre-seed seed. I would argue that, whilst we're good at pre-seed seed, we've been bad at it, and part of the reason we've been bad at it is the SEIS and the EIS, where I have again fairly awful thoughts, but I think it actually does a disservice both to founders as well as to investors down the track as well, because A, it inflates valuations at very early stage, but B, it kind of head fakes a lot of founders into thinking that they can raise venture. And I speak to a lot of founders who are like, yeah, I'm going to raise venture. I'm like, no, like you shouldn't, and you and I both know that subset of truly venture backable businesses is becoming narrower and narrower. But I guess one of the problems that VC probably has to face now is in an age of Lovable and Firebase and Cursor and Replit and all the rest of them, where you can get, where you can get to where you would have gotten to with a pre-seed without really any capital, what is the role of venture? Like, where does venture actually come in? Now, obviously, if you're investing in hard tech, that's a different story. And of course, a lot of people, so the optimistic line is, okay, if you're investing in hard tech, deep tech, etc., then that's great because you're kind of reverting venture to what it was about, which was like solving, long-term, large-scale problems. The pessimistic view would be, well, you're just deferring the need to return capital again, because again, as we've talked about, those can take longer to come to some sort of commercial or exit reality. I would tend to take the slightly more optimistic view, I would hope. But the question arises as if businesses need less and less capital, and the sort of businesses that do need the sort of capital that venture provides shrink, because there is there are only so many climate, only so many deep tech, whereas software, again, is ubiquitous, right? You could like anything you could do on a spreadsheet, you could basically turn into an app. Does that fundamentally mean that there are just going to be too many dollars chasing too few businesses? And then, what does that look like?
Yeah, I mean, I don't think so. I think as software's compressing the timelines to develop in software, is doing the same in hardware. So we're seeing a lot of those difficult problems being solved a lot more quickly in things like material discovery and things like quantum, where the timelines have historically been too long for venture. So I think, and I think a lot of those are still going to be very capex heavy businesses. I think we'll see ventures slightly transform. I think we'll see more funds that blend pre-seed seed funding with first of a kind infrastructure funding, because I think that is where the funding gap is at the moment for a lot of these hardware businesses. It's at the Series A, Series B stage. Yeah. I think we'll see corporate venture play a lot more, where they're also the customer of that technology as well. I think we'll see hybrid approaches where we have some LPs working with CVCs as well. I think there'll be some really interesting stuff there. In terms of there being too much money for the startups that are out there, can't see that happening in the immediate term. I mean, there's definitely a gap of funding at the moment, certainly in the UK, in terms of what's available.
But which is weird, because there is a ton of capital out there. There's a huge amount of dry powder. So is it more that again, as ventures reverted towards this sort of let's fund the big stuff, is it that too many founders out there trying to create kind of suboptimal businesses?
Yeah, I mean, the problem with that is that as you said, the funding going to sort of the business as usual funds, these like AUM machines, and it does lead to this massive mean regression where it becomes no one got fired of hiring IBM essentially within a venture fund. So I think hopefully we'll see more cash come to the funds that have conviction behind contrarian companies and people with a contrarian view on the world, because those people will always exist, right? In 10 years' time, there will still be people that see systemic problems within different industries and within the products that serve them as a consumer. So I think that's broadly how I see it. And as I've said, I think the problems that are created from the solutions of the moment, I think those will need to be solved by founders, right? I mean, if you look at the internet boom, I think that completely changed the need of startups. Yep. So the startups that exist now would have made no sense if you explained them to someone in 1995, 1990.
Yeah. I can't even remember. I think I was just enjoying life before my A-levels. Interesting, you talked about contrarian, sort of the contrarian position. I like, again, something that I think about a lot. So just to round off the podcast, what is one thing that you have a contrarian conviction about yourself from any area of life, whether that's work, politics, socially, or at home?
I guess maybe staying on the theme of these problems being solved, I think, given the amount of automation that is happening, I guess the cost of goods will come down, but I actually think unemployment will rise faster than that. So I think my contrarian view is probably that we need to start retooling for that immediately. I think mechanisms like universal basic income need to become something that government consider really seriously to provide that safety net for people, because I actually think that solves a lot of the problems that we've talked about earlier when it comes to social mobility and allowing people to take that risk. I think if there is that state-funded safety net, it allows people to really chase after what they believe in. Yeah. And I think that has net benefit across most areas of society.
And it's worked in the Nordics where they've trialed it.
It's worked in the Nordics. There's a really interesting study actually in Canada where they trialed it, worked really well. All of the KPIs they were going afterwards were in the positive, apart from divorce rates went up. And that was largely, well, and initially they attributed that to women having more financial freedom themselves,
sure.
which is obviously a mental thing to say no to. And that's why they binned it. And then actually it turned out that was an accounting error. So divorce rates hadn't gone up. So, I mean, it's something that I'm a big proponent of.
Not divorce rates.
And not divorce rates. I think, UBI is something I'm a big proponent of. And I think it's something that governments will need to start taking very seriously as embodied AI starts impacting the workforce. Because actually, if you look in the US now, unemployment rates are hugely on the up.
Yep.
And that is within grads as well. So the rate of unemployed graduates in the US at that age is now at the same level as non-grads.
Yeah. I again, this could be a completely separate podcast. I agree with you on UBI. I do wonder whether we have the political will. I mean, certainly if you look at any of the political discourse at the moment, I think it would be incredibly difficult for any government to propose. I think we need a massive systemic shock that forces them into it. I don't think that any of our, or certainly any of the parties that we currently see on the UK political scene being able to propose it and really back it and more importantly sell it to the electorate. But I absolutely think, and I think about this a lot because I have, two young, well, not young, I have, an 18-year-old and a 24-year-old. My 18-year-old still has like 3-4 years of school and university to go. I wonder what she's going to be doing in 5 years. Like, honestly, I do wonder. My elder daughter, it took her a while to find a job. She's in an internship at the moment, but who knows? She has other stuff going on in her life. But it is much, much harder, and she's a science grad, right? Like, it is much harder to, it's much harder to get into employment. It's much harder to get into the sort of jobs that you want. There is massive competition. There is competition not just locally, but globally, with the rise of remote work, etc. I think, if I think about, what would I love to be doing in my life? I'd love to be in the studio 24/7, just recording interesting conversations with people. But sadly, I have to work. Well, I say that. I pretend I have to work. But just as we round up finally, so we can get to know the real you, what is something that moves you the most emotionally?
I think maybe it's a cop-out answer as a VC, but I think really watching people do what they love doing. Yeah. And maybe it's because I'm lazy. I love watching people from the sidelines do that. But I think be that start a company or be that like really chase what they want to do creatively. And I actually think that, I mean, going back to what we're talking about UBI, I think that's the kind of stuff that facilitates. It allows people to really do what they want to do. And I think that when you look at like AI for content creation, I don't know about you, but I've never seen a piece of AI generated content I felt has really like resonated with me on an emotional level. No. And I think the data of your emotions, I think, is very hard to capture and feed into an AI model. So I don't see there being a future where an artificial intelligence can create something that really knows how to spark that memory in me that makes me feel a certain way. And I think that that's something that other people can do, right? Because you resonate with other people's stories and other people's very rogue experiences.
Yeah.
So people's choice and the way they go about following those dreams, I guess, and the things they love, I think, is something that definitely moves me.
I don't, I mean, as someone who used to write poetry, take, love photography, all these sort of things, and then realize, well, can't really do much with this, so kind of stop. But exactly to your point, like if you go on LinkedIn today, every post seems to be AI generated, and they are just awful. And like, so obviously AI generated, I think, is the other problem. But I think that's because many people don't know how to tell a story. I'm like, I say, at the end of the day, on LinkedIn, I think it's only 1% of the billion odd people on the platform that actually do post regularly. But most people don't know how to tell a story, don't know how to write, don't know how to do these things. But exactly to your point, I think if you have the freedom to actually explore the things that give you some joy, you go out and pursue them, and amazing things happen, right? Like you may find the next Mozart, you may find, the next Garcia Lorca or whoever it is. Sorry, Spanish reference, but couldn't think of a British writer. Terry Pratchett. There we go. You might that person may just arise. Listen, Harry, it's been absolutely wonderful having you on the podcast. For the audience, where can they find you online? You're on LinkedIn. Are you on Twitter? Where can they find you on the internet?
Yeah, LinkedIn, Twitter as well, although I'm less active on there since it's become a bit of a hellscape. Yes, 7% is 7pc.vc, and then Social Mobility Ventures is just socialmobility.ventures.
Amazing. Well, look, it's been an absolute pleasure having you on the podcast. Thank you so much for joining me.
Thank you very much.